welcome to the HX webinar series. Join the Investors Winning Circle via Angel Sidecars. My name is Scott Jordan. I am the founder of HealthiosXchange, and co-presenting with me today is Degheest, founder and managing director of HealthTech Capital. HealthiosXchange is the premier investment marketplace dedicated exclusively to the global healthcare industry, employing crowdfunding as the cornerstone of a new funding paradigm. HealthiosXchange offers direct access to the broadest opportunities on a fee-free, carry-free basis in the most trusted online environment. Since August 2nd, over 1,400 members have joined HealthiosXchange, including emerging growth company executives, accredited investors, investment professionals like Ann, and strategic buyers. So welcome again, everybody. So real quickly, what I'd like to do is just go through the quick agenda here. So first of all, I'm going to introduce Ann. She's going to take you through HealthTech Capital. Then we're going to talk a little bit about next generation capital raising. We'll talk about the access for accessing accredited investors by Angel Sidecars. We'll go into the Champions program, and then the Champions program versus Angel List. Provide some contact information for both Ann and myself if you'd like to follow up with us. And we'll take a brief Q&A. And there's a couple slides in the deck on HealthiosXchange. Okay, so having said that, let's turn over to Ann here.
So my name is Ann Degheest. I'm the founder and managing director of HealthTech Capital and MedStars, and I'm going to kind of walk you through a couple of slides. Quick background, I've been an investor and an angel investor for the last 25 years, as well as a serial entrepreneur. I really coined the word health tech as a new space that's different than medical devices and biotech. And we're going to talk a bit later about the reason why. A lot of these technologies had really problem raising the Series A and the seed funding, which is why I started HealthTech Capital. If you can see from my background, several of these companies became game changers. And I think 8 of them went public, and several of them were very successful acquisition before or after an IPO. If we quickly go into HealthTech Capital, the idea there is that in health tech, to really understand the space, you need 3 sets of expertise. You need to understand all the complexity of healthcare, the FDA, the reimbursement, the workflows, and also understanding how we can use information technology to enable new revenue and business models, as opposed to just taking an existing workflow and putting it into a mobile platform. And the key in the holy grail is how do we get people to change behaviors? Would it be a nurse, a physician, or consumers? So what we discover is that really to do that, it's really difficult to have a couple of human beings having all that knowledge. And so we create an ecosystem that we call HealthTech Capital. We're bringing people who have one of or 2 of these 3 experiences that we need. And we have also developed a relationship with industry and venture capitalists. We're also going to talk a little bit later about the fact we're organizing our own HealthTech conference to really put together in the same room all the key players in healthcare that are trying to change the systems. So if you look at the HealthTech Capital ecosystem there, a third of our investors are physicians with deep clinical expertise. The rest of the groups are people coming from being entrepreneurs in their own rights in the healthcare industry or coming from the technology side. We also have venture capitalists who are members. It's very synergistic to our system as they can bring us early deals and could invest with us or after us. We also have a relationship with some major industry players. We found that there was something different about the health tech space is in that the industry comes earlier. And very often they invest with us and develop business relationship with a much earlier companies that you would traditionally see in medical devices or in biotech. And we have physicians who are part of community hospitals all the way to major academic centers in the San Francisco Bay Area. Our vision is that company needs more than seed capital. They also need introduction to the VCs to make sure what's needed in their milestones, and so that they could be fundable by the traditional venture firms. We also find out they need a lot of mentoring. We do get involved when a company may be as young as 2 to 3 people, and we tap our membership system to bring people on board or advisors to really help them fine-tune their value proposition. We also use our network to open the door so that they can validate their value proposition. especially right now, there's a lot of activity in the space, and the winner is going to be the people who can validate their pain points and develop an ROI that will basically get more venture investors to come after us. We also have been extremely successful having strategic partners working with us as co-investors and bringing distribution channel expertise. We've put together the HealthTech Conference, and this is our second year. You can see on the website, HealthTechConference.com. We're a sold-out event this year. We over 340 attendees, all the major players from the hospital provider side, the payers, and the investors, as well as entrepreneurs, all got together in a one-day event. We had 40 companies, and as you can see, we got fantastic feedback. So I highly recommend it if you look in 2014 to look around the middle of October for our next conference. But we have becoming a flagship in the industry as far as where things are happening. Why is it such a hot space right now? If you look about what happened during the e-health, which is the dot-com years, most of these companies not succeed because they were really entrepreneurs trying to push the ball up the hill, trying to use the internet as an enabler for new approaches. This is fundamentally different. This is a tectonic shift in the industry in the sense that the forces of change are being driven by the existing players. The government, as you all know, for Obamacare, but also the change in the payment system, is forcing a change in the risk that is going to be passed from the traditional insurance and the employers is going to be passed really to the providers and ultimately to the patients. The employers also have discovered that they can no longer sustain the increase in healthcare costs, and it's can negatively impact their competitiveness worldwide as well as their EBITDA. And so we see massive change being driven by employers who are forcing their employees in private exchange and are forcing them to change behavior, otherwise they end up with higher and higher deductible and copay. So we see massive forces that will not return to where it used to be 10 years ago. It's a fundamental shift. What is also different right now is that it's not just one technology like the internet. We have software as a services revenue model that has emerged to be very successful. Mobility is clearly enabling massive changes in delivering care wherever the patients are instead of where the providers are. And of course, social media, big data and sensor are hopefully enabling us to change people's behavior. So this is a fundamental change of 16% of GDP. So the challenge is that it's really changing the whole pyramid. It used to be that everything was driven by the payers that were then telling the prices to the facilities they're willing to pay for, and at the bottom of the pyramid were the patients. What is happening right now is that we're really flipping the pyramid upside down, and we're trying to really move the way we deliver care to the patients wherever they are. It is creating massive opportunities at all layers. How do we help physicians deliver care differently? How do we help providers basically deliver care in more efficient manners? How do we change the payment system for the insurance industry where the whole revenue model is being turned upside down? So it's creating massive amount of opportunity, but the complexity is enormous in understanding which one of the companies are going to make it and which one of the companies that may not succeed. There's a big fundamental change right now, which is traditionally in life sciences. What the venture industry has done is to really parcel out investment to try to de-risk the product risk. And that's usually, does it work in the lab? Does it work in human trials? Can you convince the FDA that it's safe and effective? And can you get somebody to be willing to pay for it from your reimbursement code? And as you know, that model has been extremely difficult to make money. The technology model is exactly the reverse. They don't know where the next Groupon and Facebook is going to come. So they do more the spray and pray at the beginning there with small amount of capital. And then as soon as this company emerges as winners, then they pile up because the valuation goes up very quickly. Right now we're having a very interesting approach to the health tech sector. We have the technology VCs coming into the space thinking that it is the same type of de-risking on the market side and throwing a lot of money at probably very high valuation in the early stage, knowing that 99% of them will not make it. It is still unproven that some of these will end up in billion-dollar valuation at a Series C. We believe the model is really a hybrid of both, where you probably will take a little bit more money for the seed and the Series A, so you need a runway and the syndicate and the value-added experts to help this company figure out the revenue models. Then when you have it, it does scale up much faster than you will have in life science. So it's really a combination of a high market risk, which is having the ability of the understanding complexity of the ecosystem in healthcare, but also the fact it's changing in the payment system and the change of the providers who are all being merged right now. So it's a massive change of the industry. And the ability of being comfortable with technology risks that are low, but also means that there is very little IP, and it's really the idea is to quickly move to a prototype, identify what works, and iterate until you have a revenue model that works. So we think it's a new value proposition, where we have developed a lot of expertise. We do the traditional angel group approach, where we have members across the country. We have used Degheest as a portal right now, where we put the deals with our members providing a ratings, so we can leverage the expertise of the group. We webcast or screening. We have a whole system there where we share the feedback to the entrepreneurs, so people are really coming to us not only to invest but also to get a lot of value-added feedback. And then we have a dinner presentation there where we really go much deeper, and then we'll do the traditional due diligence process there, where we use co-leads, we reach out to a network to develop the expertise we need to check into it. In certain cases, we drive the term sheet, and in other cases, we may follow a venture member with a carve-out. We're very active in all our deals. We usually expect to get a board seats or be advisors into these companies, because we do believe that just funding the company and investing is part of the equation. The key to success is to be able to help them afterwards navigating this market risk and adapt their revenue models to what they learn as they basically execute. We have looked at over 750 deals since we started the group in 2010, and we have invested in 12, which is not atypical, for angel group or micro venture funds. So that is a kind of really very fast overview of why health tech is an enormous space. 16% of GDP is being turned upside down. There's going to be a monster company emerging, but you have to be really careful how you pick them. Scott, I'll let you take over.
Thanks, Ann. That was great. So we're going to, if I can expand my screen here, we're going to go into next generation capital raising. So let's just take a look at this. For those who have participated in some of the previous webinars, this is a slide you've seen before. But what's really important about this is crowdfunding, and there's seven different areas here, but there's a few that I would like to highlight. The second one down. The Jobs Act is fueling crowdfunding because it lifts the general solicitation ban and what they call is 506C. The HealthiosXchange is working under 506B, but 506C is available and I think we're going to incorporate that in the future. The other one below is really important as well, which is raises the shareholder cap from 500 to 2,000. That's really important for companies that are looking to raise money via crowdfunding, because usually the definition of crowdfunding obviously is a small amount of money from a large group of people. And so you could run up against 500 very quickly, and so that was very, very important as well. And then down the road, there's going to be legalizing of crowdfunding probably next year. Our site is specifically accredited investors, not accredited. And I think most of you know the definition of accredited, but it's $1 million net worth minus your house, or made $200,000 for the last few years. So those are some of the that's basically legislation impacting what we're seeing, which is very exciting. Okay, so let's go to the next slide. So crowdfunding plus angel investing. So we've got this thing, crowdfunding, right? That's being supercharged by legislation and advancements in social media. And if you take a look at the markets that are out there, there's a lot of money going into private companies, or what some people call private equity. In the middle there, you'll see angel investing. In 2002 or 2012, $22.5 billion was invested in angel investing, and over 66,000 deals. Now, some people ask, you have venture on the right-hand side, which is $30 billion. You've got friends and family at $60 billion. You've got Reg Ds as a whole, 37,000 filed, 905 billion raised. And I still think 22.5 billion is a very big number, but some people wonder why it's not larger. And why are those 60 billion invested in family and friends? Why aren't they participating in angel groups. And so you'll see some of the historic, you could call it limitations. Some people might not see it as limitations. At the end of the day, some people don't want to pay dues. The investment minimums might be too high for them, especially in a binomial risky asset class that's capital intensive, such as pharma, biotech, medical device, diagnostics. And then, of course, some people just do not want to participate in groups. So that historic opportunity is for angel groups, which is that money that's going into friends and family outside of angel investing. Can that be packaged within the angel construct? And more importantly, can those people that are investing that money become angel investors themselves or angel group members? Okay. So one of the keys is then that you've got all these people in the friends and family area. How do we access them, these accredited investors? And once again, we are only accredited. So the not accredited is something that some of the other sites are employing in their platforms, but we are not. So when we take a look at angel investing, or angel investors, accredited investors, they like healthcare, but it's limited to funds. And so of the 8 million accredited investors in the U.S., 41% who have invested in VC funds, only 5% have invested directly, and that's for some of the reasons that we mentioned before. So it ranks really high. You can see biotech, healthcare services, medical devices, and equipment ranks really high. I mean, there's no surprises there given the fact of the growth rate in the sector, the percentage of GDP, the opportunity for outsized returns, such as, say, getting into Regeneron, Pharmacyclics, or Onyx, just to pick those companies, massive returns that are available. But only 5% have direct investing. So can crowdfunding change that paradigm? That's the interesting question. Why such low participation rates, right? We talked a few about these. You've got geographical limitations, right? You don't live in some of the hot spots where the angel groups are. The investment thresholds are too high, so I can't diversify. I don't want to put that much money into one company in the space. Diversification is difficult, right? Annual dues problematic. Angel groups require participation. And then on the bottom, the challenges with raising small amounts of capital per investor. Most companies are not interested in someone that comes to them and says, hey, I want to put $25,000 in your company. And then the other is that fragmented capital structures, problematic to follow on capital sources. So venture capitalists are not interested in those cap structures where you have 200 retail investors, potentially each with their own lawyer. So crowdfunding, solves many of these problems. And one of the ways that crowdfunding does is within this angel sidecar construct, because basically what we have created is these angel sidecars, or what you can call syndicates. And AngelList has done a phenomenal job with their syndicate model. But in this instance, these angel sidecars, we basically give accredited investors the ability to invest in private companies via special purpose vehicles, who essentially are limited liability companies. So that takes off the fragmented cap structure for follow-on capital off the board. Or accredited investors can go directly, or they can go via syndicates, which Ann and I are going to discuss here in a few minutes. So the interesting thing about the syndicate model is you can invest alongside lead investors. And the lead investors can be a company or an individual. And an angel group could be a lead investor, like HealthTech Capital. They could be, and we call that a single purpose type model. And then the angel group investor is the lead investor, which is VIP, which we're not going to talk about in this call. But the lead investor, what's advantageous about it is that the lead investors take lower carry than traditional venture funds. So that's one of the attractions to accredited investors. The investment thresholds are as low as $1,500 per syndicate investor. So that takes the I can't diversify in a risky asset class off the table. It aggregates the investors in the SPVs. And then the ease of use. Some people just don't invest in the space because it's just not easy. And so can I do the due diligence online? Can I meet people online? Can I peruse the documents and do the legal documentation online? The escrow, the payment, like PayPal. So there's a lot of advancements with technology and a lot of advancements with social media that allow these investors to participate in an asset class that they might have an interest in, but due to some of the limitations have not participated in the past. So having said that, we're going to get into a few structures for you guys, and I'm going to, Ann and I are going to talk a little bit about some of these sidecars, but our sidecar platform is called the Champions Program. And so the first slide here, let's go here. I just want, before I turn it over to Ann to talk about a few of the structures, I wanted to go through a summary of terms because you're going to see this with us and you're going to see it with AngelList. But let's just go through some of the terms real quick. There's a lot of information on this slide, but we'll push forward. But the angel sidecar is basically invest alongside of prominent angel groups like HealthTech. What is a backer? The backer is committing an amount to a future deal made by a syndicate lead investor. And I think most of you guys know what carry is. The HX Champions program gives accredited investors the ability to lead, collect, for a fund of capital for a specific startup. A lead investor, in this case HealthTech Capital, would provide syndicate members access to premium deal flow and govern the investment process. And so crowdfunders, investors have the ability to invest alongside of HealthTech, thus the term sidecar. Micro VCs, right? These are really mini VC funds. Invest in a fund which invests in a number of companies or in one company, and there's no management fees or lockups. Special purpose vehicle, what is that? It's an LLC legal structure formed to consolidate investors. Syndicates, group of investors in an SPV organized to invest in one company. Syndicate investors, they invest alongside of lead investors in this VIT platform. Okay? So having said that, I'm going to turn it over to Ann, and she's going to talk a little bit about one of the models that we're employing, which is the single purpose fund, and it has a VC exemption. So Ann, why don't you go ahead and take the reins here and lead our participants through this model.
Yeah, thank you, Scott. So what we're exploring here is, and it's just for demonstration purposes, is the fact that let's assume HealthTech Capital has done, a lot of screening of companies, and let's assuming out of 50 companies we find one that we really like, and we decide to take the lead, and we're going to do a close. And so the idea is that we will be sharing with people who are interested in maybe joining us in the syndicate, and we will be creating with Healthios an LLC that will allow the people in the crowd exchange who are accredited investors to put some capital and follow our leads. And so the structure that we're exploring right now is that all the money from the accredited investors will go into the LLC. At the exit, the HealthTech Capital Management Group will receive a 15% carry for really helping identify the company, doing the drive of the term sheet, but more importantly, following the company afterwards and making sure it's going in the right direction. I believe my understanding, Scott, is that the company, after they receive the funds from the LLC, will pay HealthiosXchange slightly less than the 5% administration fee. You may want to go over what HealthiosXchange will provide.
Yeah, so HealthiosXchange is going to provide a turnkey approach to these syndicate models, meaning setting up the limited liability corporation, the special purpose vehicle, the legal documents, which are the operating and subscription documents, setting up the escrow account so that the funds can be held in escrow prior to being released to the company, and the annual registration and tax filings on a state level. So that's basically where the fees will go.
And that's the traditional K1s. So if people are familiar with those statement that you have to file with your April 15 taxes. The next slide. So the next slide is that we all know that to really be a successful angel, you need to build a portfolio. And the portfolio, typically, what the Kaufman Institute has shown, that you need at least probably 10 to 12 companies in your portfolio to have a good diversification, to get the one or two that are going to hopefully outperform and give you a very high return, and to compensate for maybe some of the losses. So one of the other areas we're exploring is to allow accredited investors to invest in a micro VC fund, which will be then spread around the company that we will be investing into the HealthTech space. It will provide investors who prefer to be passive and don't like to make a decision on a deal-by-deal basis, to really allocate a piece of their investment into the health tech space, which is extremely hot right now, and still have the diversification of a portfolio approach into multiple area of the health tech sector. Because remember, health tech, as a rule of thumb, medical devices around 5% of healthcare spending, drugs is between 8 to 10% of healthcare spending, and really the rest is healthcare delivery. And so we are really focusing on probably 85% of healthcare costs and try to see if we could disrupt those models. So there's going to be a lot of different type of play. Some may be insurance plays, some may be patient engagement, some may be direct to the consumer, some may be people selling to the employer. So it's not like it's all medical device and biotech. It's a very wide space. So having a portfolio effect there would be highly recommended. The other thing that we do is that when we get involved, so that you're aware of it, that we really believe in working with this company very closely. So we tap our network of health tech members as well as people that we have a relationship with to really be active on these companies. And we usually ask the company to compensate for their time going on forward after the investment with stock options, so that we have an alignment in creating values at the level of the common, and if the common is successful, the preferred is always successful. Next slide. Oops, you missed one.
Yep, sorry.
And so having the idea that is, we're exploring different type of microfund as well as direct angel investing, working with Healthios as a preferred partner in reaching out to the accredited angel investors across the country who may not have access to the Silicon Valley deal flow, as well as to the expertise in evaluating these companies, determine which one is a good one, and build a portfolio to diversify the risk. Next slide. I think I go back to you, Scott.
So, is that it? And is there anything else you wanted to talk about with these three?
No, I think this is kind of the area we're exploring, and we'd love to get some feedback.
Okay. Okay, we just had a question come in, and I'll let you take this. What are the advantages to an investor of syndicating versus just investing outside of the syndicate? For us, like if this individual, I think this is what she's trying to say, is they see the advantages probably of investing alongside of health tech, but what about them just investing directly into the company outside of a syndicate versus syndicating with you? What would be the advantages of partnering with you?
Well, the first one, you need to identify these deals. What we find out is that the really very good deal don't necessarily go to crowdfunding in a traditional sense. And so they usually come via our network of venture capital and industry partners. So those deals, some of them we even stay stealth until, the company is launching their products. So these very hot deals may not be available to somebody who's just kind of looking at an angel list, for example. So that's the first aspect, is finding the right deal. Number two, really what we find out, it is complicated to really identify these deals. You have to understand the clinical workflows. You have to understand issues with reimbursement. Right now, clearly, the FDA is coming back into the space, so you have to understand how to kind of leverage the good and the bad about having the FDA involved. So the group provides a lot of expertise in identifying these deals, but also vetting them during the due diligence process. So having access to that would be very valuable. And we'll probably provide a summary there with all the disclaimers. And then the third area that, I think the Kaufman has shown in their very interesting report looking at 1,500 deals is that, if you're not active afterwards, and that's the power of the group, is that we stay active with those companies by leveraging the group, is that your chance of success goes down significantly. So I highly recommend people to look at the Kaufman report that clearly show that if you spend 40 hours of due diligence in assessing deals, you have a significantly higher chance for a return. And if you're active after the company and talk to them regularly, like several times a month, you're also significantly active. It's really hard to do that if you're on your own and you're trying to build a portfolio of 10 companies, and the typical ratio is that you have to see 20 companies to invest in one, if not a higher numbers. If you look at the venture industry, which is 100 to 1, it's really hard for individuals to do this on their own unless they do this full time. And even that, you may not have access to all the expertise and the network.
Thanks, Ann. The next, actually, it's kind of funny. We had a question come in, and I'll take this one, but it just said, how is this program, this platform, different from AngelList? And by the way, I have the utmost respect for AngelList. A great organization doing some very creative and innovation in the space. But this Champions program versus an AngelList syndicate, okay? Let's take a look. In the middle are the factors that we'll look at as we work our way down the page. But let's just say we're going to start at the top, and the lead investor, is an angel group on our side, and on AngelList it's an angel investor, okay, under this platform. The syndicate investor, who is the investor that is following or investing alongside of the angel group or angel investor, what is the syndicate investor paying? And if you take a look at AngelList, they're paying 20%, of which 15% goes to the lead, and then 5% is actually, you'll see the portal below. The portal's getting 5% goes to AngelList. So under our model, the syndicate investor essentially gets pays 15% under all of our models, and under our platform, the portal that's HealthiosXchange does not receive carry like AngelList, but doesn't. So that's a key differentiator, and that's why I kind of highlighted on the right. Below, the angel group receives carry, which is another big difference. So on the angel group side, HealthTech, for example, would receive 15% from, like, for example, we have 1,400 members in our portal, and those who decide to syndicate with HealthTech, they would pay 15% carry, either under the single purpose or under the micro VC platforms. Under the angel list, the angel groups do not receive carry. That's another differentiation. We'll go down to due diligence. The angel groups, obviously, that's one of the biggest, positives about partnering with an angel group that's leading an investment syndicate, is that they have a great deal, an unparalleled ability to do due diligence, given their backgrounds. Whereas an angel list, the due diligence is, I guess they rely on social media, which is great. They look at the investors who are in the deal to see if they want to go in this case, the angel investor, but there, in our opinion, is not a great deal of due diligence there. And the last thing is qualifying the deals, and these are screened and vetted by angel group, versus angel list, which essentially what they do is they look at most trending, which is not, I think that's social media at its best, but I still think there's gaps there as far as the correlation between what the crowd thinks is a good deal and what is actually a good deal. I do think I see the advantage of that as well, but we feel that the angel groups who have, in some cases, 20, 30, 40 years, per person in the angel group of experience in the healthcare industry can make, better choices as to the right deals. Ann, is there anything that you want to, since I went through this, is there anything you want to point out as far as what you found attractive about our model versus AngelList?
Yeah, I've been a member of AngelList, and I somehow, it has not engaged me. Let me just be me. I find out that at the end of the day, when we invest at the stage we're investing, which is really one of the first, financial investment, really looking at the person and doing the due diligence on the individuals is critical. Usually you succeed if the entrepreneur and the team is a very good team, and they figure out how to change their products into something that's successful. I found that hard to do on AngelList because I don't invest in space, I invest in people. And so having the ability, having these people present to us, put them into the pressure cooker of the screening and the dinner presentation, due diligence, is really essential to identify the winners. That's me personally.
The accredited investor network effect. So what's the benefit of participating and syndicating alongside of an angel group such as HealthTech? And one of the big, I just wanted to highlight this because this is really the impact of social media and this investor network that we built at HealthiosXchange, and that is that these press releases and different correspondence going out in monthly newsletters and articles, and we do one-on-one road shows in cities of interest that are strategically positioned like San Diego, San Francisco, Boston, and others. But we have, you'll see the members that we have, and there's a real strong contingent of individuals who could be angel group members. They could be lead or syndicate investors, for example, or they might just want to keep track of some of the deals for future reference. Maybe they're not ready now, but in the future it will be something that they might take a look at. So we've got a very robust network that this is really when it comes down to is the exposure. And then also the interests are aligned with companies and investors. The interesting thing about HealthiosXchange, it's one of the only, if not the only, crowdfunding portal that's led by a investment bank. In this case, it's sponsored by Healthios, which has got a distinguished track record raising money from venture-backed companies. And in this case, you'll see that we have 4 crowdfunding portals. We do not think that companies, that crowdfunding alone, will be able to raise the amount of capital needed or required by a company during its life cycle. The average pharmaceutical company raises in excess of $49 million over 5.7 years. Those are the successful pharma companies. And at this point, one of our peers over on the consumer goods side called Circle Up, doing a great job. I think their maximum deal right now is $3 million. So just like peer-to-peer lending or iTunes or any of these disruptive or disintermediating technologies, essentially it's in comparison to venture dollars and stuff, it's small, but it's going to grow, and there's no doubt about that. In this case, right now, angel groups receive the carry and not angel list. We think that's the proper structure. We don't receive any carry whatsoever. HealthiosXchange is a registered broker-dealer. We think that's very important given all of the myriad of regulations and legislation changes that have happened in the last year, especially with the Jobs Act and the 506B and C. And then in the future, we may open it up to 506C, which means generally soliciting to those you do not have a pre-existing relationship. By the way, once again, 506B means that you vetted someone as an accredited investor, like when they come into our portal. 506C means that you just broadcast it, but you have to do a lot of filings with the SEC to make that happen. We're coming to the end here, so I just wanted to provide the contact information for myself and Ann. You can obviously call me or email me, and you can email Ann at that address. On the questions and answers, we have one more question for you, and that is basically it's just saying what did you guys find attractive, or what do you overall find attractive? And I don't know if this is coming from another angel group participant, but what do you find attractive about the syndicate model, and how do you see it, I guess, filling the gap or, increasing the amount of money that you can raise for deals?
Well, we haven't done it yet. I mean, so right now what we find is that somebody has to do the heavy lifting, which is do the due diligence, negotiate the term sheets. Very often you have to clean the cap tables and really kind of get the company to be ready to be invested by investors there. So it's really hard for angels to do that if we're not able to write big checks. If you remember in the health tech space, I mean, it doesn't take $100,000 to get a website out and see if the company will work, and it takes more capital than that. The average angel group, I think, in the country has been reported to put, around $350,000 is what I think the Hill report came out recently there. We found that that if we could do the anchor of the deal and do a partial close with us first, and do maybe a 30-day close or 90-day close with the HealthiosXchange for follow-on, it would increase the runway of the company, and it would put us in a position to be much stronger and to negotiate better deals for the angel group, giving the runway to the company, and reach an inflection point that will be much higher, and to get it to be venture ready at a higher valuation. So they will provide a better return to all angels because we have a longer runway and more power to negotiate a better deal.
That's great. Thank you so much. We're out of time, but I'll go ahead and email you offline for the remaining questions that we have. But I'm not going to go through these slides, but it'll be included in the deck, and that's basically, if you're wondering what HealthiosXchange is, and then what, Ann talked about the Kaufman study, and this portal was built in response to some of the recommendations that the Kaufman Foundation had as far as lowering the fees and allowing investors to invest directly into companies versus having to go through funds, given the difficulties associated with returns over the last 10 years. So thanks again, everybody. Ann, it's been a pleasure to have you on this call, and we encourage everybody. We're going to have another webinar here in the next couple of weeks. Does size matter? It's going to be positioned for strategics, emerging growth companies that are looking to sell to or find buyers from pharma companies. Thank you so much, Ann. Have a great week, and we'll talk to you soon.
Thank you, Scott.
Thank you.